The year 2025 was a big one for precious metals. The numbers tell a powerful story. You need to understand them. Silver started the year around $30 an ounce. By the end of December, it had soared to over $70 per ounce. That is a staggering 147% surge in just 12 months. This kind of move gets everyone's attention. It signals that something fundamental has shifted in the market. This is not normal market noise. It is a major repricing event that you cannot afford to ignore, as it reflects deep changes happening below the surface of the global economy. Gold also had a historic year. It began 2025 at about $2,600 per ounce. It then climbed steadily, breaking through the $4,000 barrier and hitting a high over $4,300. This represents a gain of roughly 64%. The momentum did not stop there. In January of this year, 2026, gold reached another all-time high, touching over $4,800 an ounce. This confirms that the trend is not a one-time event. Major financial institutions like J.P. Morgan are now forecasting gold prices could push toward $5,000 by the end of this year. These are not fringe predictions anymore. They are mainstream analyses based on concrete data. These gains were some of the strongest we have seen for gold and silver since the bull market of the late 1970s. Back then, huge price spikes happened near the end of the cycle, not the beginning. Gold jumped over 120% in one year, and silver surged over 400%. If history is any guide, the moves we saw in 2025 might just be the warm-up act. So, what caused these explosive moves? It was not just one thing, it was a combination of three powerful forces. Driver 1, supply and demand imbalance. For silver, we use more than we produce. 2025 marked the fifth straight year of a silver supply deficit. We've been dipping into stockpiles to meet demand. These deficits are significant. From 2021 to 2025, the shortfall was nearly 900 million ounces. That's almost a full year of global mine production gone from reserves. Driver 2, revolution in industrial demand. Silver isn't just for jewelry anymore, it's a critical component in the world's most advanced technologies. Industrial uses now account for over half of silver consumption. Solar panels, electric vehicles, modern electronics, hardware for artificial intelligence. Solar alone will consume more silver every year through the 2030s. That creates a strong, consistent, and growing baseline of demand. Driver 3, the macro backdrop. Last year was filled with economic uncertainty. Inflation remained persistent, eating away at purchasing power. When paper money loses value, gold and silver shine. They are finite assets that cannot be printed by a central bank. They act as a counterbalance to currency debasement. The price swings of 2025 are not just news headlines. The price swings of 2025 are not just news headlines. They have real-world consequences for your financial well-being. The first thing they tell you is that your savings are at risk. The very same forces that pushed gold and silver higher are eroding the value of your cash in the bank. Every day that your money sits in a standard savings account, it buys a little bit less. This is the silent theft of inflation. The surge in metal prices is a clear and visible measure of this ongoing currency debasement. It is a wake-up call to protect your wealth from this invisible drain. Second, these moves highlight the difference between gold and silver. Think of gold as your defense. It is the stable bedrock of a sound portfolio, a form of wealth insurance. It provides stability and is the ultimate store of value during a crisis. Silver is your offense. It is more volatile, meaning its price moves up and down more dramatically. This volatility means it has the potential for much higher returns, as we saw in 2025, but it also comes with greater risk. Understanding this distinction is key. A smart approach uses both metals to capture the benefits of stability and growth potential. Third, the events of last year show that the old rules of investing may no longer apply. For decades, a simple portfolio of stocks and bonds was enough for most people. Today, that is a dangerous assumption. Geopolitical instability, persistent inflation, unsustainable government debt have changed the game. Section 4. Your action plan. 7 steps to take now. Knowing what is happening is only the first step. You must act on that knowledge. Here is a clear, 7-step plan you can begin implementing today. Do not try to do everything at once. Start with the first step and proceed deliberately. The goal is to build a resilient financial position, not to get rich overnight. This is about wealth preservation in an uncertain world. Taking these small, manageable actions will put you ahead of the crowd and provide peace of mind as events unfold. First, define your objective. Ask yourself a simple question. Why am I buying precious metals? Is it to speculate on short-term price movements? Or is it for long-term wealth preservation, insurance against a crisis? For most people, the answer should be the latter. Your objective will determine your strategy. A speculator trades frequently. A long-term holder buys and holds for years. Be honest with yourself about your goals before you spend a single dollar. This clarity will guide all your future decisions and prevent costly emotional mistakes. Second, determine your allocation. Financial advisors often recommend a 10 to 15% portfolio allocation to precious metals. If you are more conservative, you might start with 5 to 10%. If you are more concerned about economic instability, you might go as high as 15 to 25%. Look at your total investable assets and decide on a percentage that feels right for you. For example, if you have $100,000 in savings and investments, a 10% allocation would mean putting $10,000 into metals. This is your target. Third, balance gold and silver. A common strategy is to allocate more to gold for its stability. A 60-40 split between gold and silver. A 70-30 split between gold and silver. Using our $10,000 example, a 70-30 split would mean you aim to buy $7,000 worth of gold and $3,000 worth of silver. This gives you a solid foundation in gold while allowing you to benefit from silver's higher growth potential. This ratio is not set in stone. You can adjust it based on your own risk tolerance and market outlook. Fourth, buy over time. Do not invest your entire allocation all at once. This is called dollar cost averaging. By investing a fixed amount at regular intervals, you reduce the risk of buying at a price peak. For example, $10,000 over 10 months, $1,000 each month. This smooths volatility and removes emotion from buying. It is the smartest way for the average person to build a position. Fifth, choose the right form. For long-term wealth preservation, physical ownership is best. Gold coins, silver coins, bars, from a reputable dealer. Or use ETFs backed by physical metal for convenience. Be aware of differences. Physical metal has no counterparty risk. ETFs rely on a chain of financial institutions. Understand what you are buying. Sixth, maintain liquidity. Precious metals are a store of wealth, not a checking account. You must keep enough cash on hand for at least 6 months of living expenses. This is your emergency fund. Do not sell your metals to pay for a car repair or a medical bill. Your metals are for protecting your long-term wealth. Your cash is for handling life's immediate needs. Do not confuse the two. A sound financial plan requires both. My one clear recommendation is this. Start now by acquiring a small foundational position in physical gold. Forget the noise. Forget the complex charts, and forget trying to time the market perfectly. Your first goal should be to get off zero. Buy 1 ounce of gold. Hold it in your hand. Understand its weight and its reality. This single action will change your mindset from that of a spectator to that of an owner. It will anchor your perspective and give you a tangible stake in real money. Once you have that foundation, you can then follow the other steps to gradually build out your silver allocation and reach your target percentage over time. The journey begins with a single step. Take it now.